So you deposit your money in your bank and you think it's safe, right? But here's the truth. Any money you have sitting in your bank account is legally not your money. So today we're going to talk about how that really works and why you should be getting your money out of the bank right now. So let's talk about it. This is the Hey Ed YouTube channel. I am your host, moderator, and all-around nice guy, Edward Anderson. If you don't mind, could you support my channel by hitting that like and subscribe button and ring that notification bell? Okay, so when you deposit, you lend. So when you deposit your money into your bank account, you are not storing it like you would be if you put it into, a Foot Locker. What you're doing is you're lending your money to the bank. Legally, that money becomes the property of the bank. And what you get in return is an IOU, in line with all the other creditors to the bank. And that is a huge risk, especially with what's going on today with the banks. The bank's business model is based on what's known as fractional reserve banking. If you deposit, say, $100 into your bank, the bank itself may only keep about 10 of those dollars in actual reserves. The rest of that money is lent out to other people and businesses at higher interest rates than the bank is paying you. And that's how the bank is making their money. They make money off of your money. And then as the people who borrow money from the bank, they make payments on their loans, that money is once again turned around and lent out. Now, this all works great until everyone wants their money out at the same time, creating what's known as a bank run. Now, here's the scary part about what's going on with the banks right now. U.S. banks are sitting on hundreds of billions of dollars in unrealized losses. Why? Well, because of rising interest rates. And that is why you are hearing the talking heads on these business channels freaking out over the bond markets. When interest rates go up, the value of long-term bonds being held by the banks, which is forced upon them, by the way, plummet. That's what brought down Silicon Valley banks and a few other banks a couple years ago, remember? Now, technically, Silicon Valley Bank is somewhat solvent because the government stepped in and bailed them out. And they bailed them out in an unprecedented way. They not only covered, the minimum account value, they covered the entire account balances. But that will not happen again. In fact, during that summer, we spent more money bailing out those three banks than we did during the entire banking system during the 2008, calamity. But again, that cannot happen again. So if you think that your FDIC insurance is protecting your bank account, let me tell you something. The FDIC is providing a false sense of security. So the FDIC ostensibly insures up to $250,000 per account per bank. That sounds really comforting, right? In the event of a systematic banking crisis, the FDIC cannot cover everyone. They will require the U.S. government and the Federal Reserve to step in. And this brings us to what's known as the bail-in era. Okay, so after the 2008 financial crisis settled down, governments around the world decided that they didn't want to do another round of taxpayer bailouts because they feared riots in the street. So they introduced a new scheme called the bail-in law. So again, rather than using taxpayer funds to bail out banks, they created bail-in laws. So what does a bail-in look like? Bail-in laws allow banks to convert your deposits and other unsecured assets into equity in the bank in order to stabilize it. And so what do you get in return? They will issue you shares in a failing bank. So this law is already on the books in the US, the UK, Canada, the entire EU, as well as other countries. All right, so what can you do about this? Okay, so none of this means that you should panic, but there are some things you should be doing in order to protect yourselves. First of all, you can diversify. Don't have all of your money in one bank account at one bank. Spread it out amongst multiple bank accounts in multiple banks. The next thing you should do is you should know the financials of your particular bank. Also, you might want to look into credit unions rather than banks. They tend to have stronger balance sheets. So look for credit unions that have strong reserve balances. Next, consider gold and silver or other hard valuable assets. And of course, the big one, get your money out of the damn bank. Now remember, the mantra on my channel is, reduce your exposure to your bank, buy some gold and silver, and establish streams of passive recurring income. And there's a reason why I chose get your money out of the bank as the first part of my mantra. Okay, so let me give you a final thought here, okay? The banking system runs on confidence. So when that day comes, whenever it is, when confidence is lost, there's some kind of black swan event, and people just decide they want to get their money out of the banks, you do not want to find yourself standing in a line to get your money out of your bank. Banks are not safe. Once you understand how the banking system works and how the Federal Reserve will resort to printing money in order to solve problems, once you become educated, you're going to be able to start taking the steps to protect yourself. So what I try to do on this channel is to try to educate you about potential landmines that could disrupt your life and your standard of living, and to offer practical solutions that anyone can do. So if this video blew your mind, or if you got some value out of it, please like, subscribe, and ring that notification bell. Ed Anderson, live from Minnesota, signing out.
Copy that.